C. Dividend policy and share repurchases. Dividend policy is often reported to shareholders but seldom explained. A company will say something like, "Our goal is to pay out 40 to 50% of earnings and to increase dividends at a rate at least equal to the rise in the CPI." And that's it. No analysis will be supplied as to why that particular policy is best for the owners of the business. Yet allocation of capital is crucial to business and investment management. Because it is, we believe managers and owners should think hard about the circumstances under which earnings should be retained and under which they should be distributed. The first point to understand is that all earnings are not created equal. In many businesses, particularly those with high asset-profit ratios, inflation causes some or all of the reported earnings to become ersatz. The ersatz portion, let's call these earnings restricted, cannot, if the business is to retain its economic position, be distributed as dividends. Were these earnings to be paid out, the business would lose ground in one or more of the following areas: its ability to maintain its unit volume of sales, its long-term competitive position, its financial strength. No matter how conservative its payout ratio, a company that consistently distributes restricted earnings is destined for oblivion unless equity capital is otherwise infused. Restricted earnings are seldom valueless to owners, but they often must be discounted heavily. In effect, they are conscripted by the business, no matter how poor its economic potential. This retention, no matter how unattractive the return situation, was communicated unwittingly in a marvelously ironic way by Consolidated Edison a decade ago. At the time, a punitive regulatory policy was a major factor causing the company's stock to sell as low as 1/4 of book value, i.e., every time a dollar of earnings was retained for reinvestment in the business, that dollar was transformed into only 25 cents of market value. But despite this gold into lead process, most earnings were reinvested in the business rather than paid to owners. Meanwhile, at construction and maintenance sites throughout New York, signs proudly proclaimed the corporate slogan, "Dig we must." Restricted earnings need not concern us further in this dividend discussion. Let's turn to the much more valued unrestricted variety. These earnings may, with equal feasibility, be retained or distributed. In our opinion, management should choose whichever course makes greater sense for the owners of the business. This principle is not universally accepted. For a number of reasons, managers like to withhold unrestricted, readily distributable earnings from shareholders to expand the corporate empire over which the managers rule, to operate from a position of exceptional financial comfort, etc. But we believe there is only one valid reason for retention. Unrestricted earnings should be retained only when there is a reasonable prospect, backed preferably by historical evidence or, when appropriate, by a thoughtful analysis of the future, that, for every dollar retained by the corporation, at least $1 of market value will be created for owners. This will happen only if the capital retained produces incremental earnings equal to or above those generally available to investors. To illustrate, let's assume that an investor owns a risk-free 10% perpetual bond with a very unusual feature. Each year, the investor can elect either to take his 10% coupon in cash or to reinvest the coupon in more 10% bonds with identical terms, i.e., a perpetual life and coupons offering the same cash or reinvest options. If, in any given year, the prevailing interest rate on long-term, risk-free bonds is 5%, it would be foolish for the investor to take his coupon in cash, since the 10% bonds he could instead choose would be worth considerably more than 100 cents on the dollar. Under these circumstances, the investor wanting to get his hands on cash should take his coupon in additional bonds and then immediately sell them. By doing that, he would realize more cash than if he had taken his coupon directly in cash. Assuming all bonds were held by rational investors, no one would opt for cash in an era of 5% interest. not even those bondholders needing cash for living purposes. If, however, interest rates were 15%, no rational investor would want his money invested for him at 10%. Instead, the investor would choose to take his coupon in cash, even if his personal cash needs were nil. The opposite course, reinvestment of the coupon, would give an investor additional bonds with market value far less than the cash he could have elected. If he should want 10% bonds, he can simply take the cash received and buy them in the market, where they will be available at a large discount. An analysis similar to that made by our hypothetical bondholder is appropriate for owners in thinking about whether a company's unrestricted earnings should be retained or paid out. Of course, the analysis is much more difficult and subject to error because the rate earned on reinvested earnings is not a contractual figure, as in our bond case, but rather a fluctuating figure. Owners must guess as to what the rate will average over the intermediate future. However, once an informed guess is made, the rest of the analysis is simple. You should wish your earnings to be reinvested if they can be expected to earn high returns, and you should wish them paid to you if low returns are the likely outcome of reinvestment. Many corporate managers reason very much along these lines in determining whether subsidiaries should distribute earnings to their parent company. At that level, the managers have no trouble thinking like intelligent owners, but payout decisions at the parent company level often are a different story. Here, managers frequently have trouble putting themselves in the shoes of their shareholder owners. With this schizoid approach, the CEO of a multi-divisional company will instruct subsidiary A, whose earnings on incremental capital may be expected to average 5%, to distribute all available earnings in order that they may be reinvested in subsidiary B, whose earnings on incremental capital are expected to be 15%. The CEO's business school oath will allow no lesser behavior. But if his own long-term record with incremental capital is 5% and market rates are 10%, he is likely to impose a dividend policy on shareholders of the parent company that merely follows some historical or industry-wide payout pattern. Furthermore, he will expect managers of subsidiaries to give him a full account as to why it makes sense for earnings to be retained in their operations rather than distributed to the parent owner. But seldom will he supply his owners with a similar analysis pertaining to the whole company. In judging whether managers should retain earnings, shareholders should not simply compare total incremental earnings in recent years to total incremental capital, because that relationship may be distorted by what is going on in a core business. During an inflationary period, companies with a core business characterized by extraordinary economics can use small amounts of incremental capital in that business at very high rates of return, as was discussed in last year's discussion on goodwill. But instead, they are experiencing tremendous unit growth. Outstanding businesses, by definition, generate large amounts of excess cash. If a company sinks most of this money in other businesses that earn low returns, the company's overall return on retained capital may nevertheless appear excellent because of the extraordinary returns being earned by the portion of earnings incrementally invested in the core business. The situation is analogous to a pro-am golf event. Even if all of the amateurs are hopeless stuffers, the team's best ball score will be respectable because of the dominating skills of the professionals. Many corporations that consistently show good returns both on equity and on overall incremental capital have indeed employed a large amount of their retained earnings on an economically unattractive, even disastrous basis. Their marvelous core business, however, whose earnings grow year after year, camouflage repeated failures in capital allocation elsewhere, usually involving high-priced acquisition of businesses that have inherently mediocre economics. The managers at fault periodically report on the lessons they have learned from the latest disappointment. They then usually seek out future lessons. Failure seems to go to their heads. In such cases, shareholders would be far better off if earnings were retained only to expand the high-return business, with the balance paid in dividends or used to repurchase stock, an action that increases the owner's interest in the exceptional business while sparing them participation in subpar businesses. Managers of high-return businesses who consistently employ much of the cash thrown off by those businesses in other ventures with low returns should be held to account for those allocation decisions, regardless of how profitable the overall enterprise is. Nothing in this discussion is intended to argue for dividends that bounce around from quarter to quarter with each wiggle in earnings or in investment opportunities. Shareholders of public corporations understandably prefer that dividends be consistent and predictable. Payments, therefore, should reflect long-term expectations for both earnings and returns on incremental capital. Since the long-term corporate outlook changes only infrequently, dividend patterns should change no more often. But over time, distributable earnings that have been withheld by managers should earn their keep. If earnings have been unwisely retained, it is likely that managers too have been unwisely retained. The companies in which we have our largest investments have all engaged in significant stock repurchases at times when wide discrepancies existed between price and value. As shareholders, we find this encouraging and rewarding for two important reasons. One that is obvious, and one that is subtle and not always understood. The obvious point involves basic arithmetic. Major repurchases at prices well below per share intrinsic business value immediately increase, in a highly significant way, that value. When companies purchase their own stock, they often find it easy to get $2 of present value for $1. Corporate acquisition programs almost never do as well and, in a discouragingly large number of cases, fail to get anything close to $1 of value for each $1 expended. The other benefit of repurchases is less subject to precise measurement, but can be fully as important over time. By making repurchases when a company's market value is well below its business value, management clearly demonstrates that it is given to actions that enhance the wealth of shareholders, rather than to actions that expand management's domain, but that do nothing for, or even harm shareholders. Seeing this, shareholders and potential shareholders increase their estimates of future returns from the business. This upward revision, in turn, produces market prices more in line with intrinsic business value. These prices are entirely rational. Investors should pay more for a business that is lodged in the hands of a manager with demonstrated pro-shareholder leanings than for one in the hands of a self-interested manager marching to a different drummer. To make the point extreme, how much would you pay to be a minority shareholder of a company controlled by Robert Vesco? The key word is demonstrated. A manager who consistently turns his back on repurchases when these clearly are in the interest of owners reveals more than he knows of his motivations. No matter how often or how eloquently he mouths some public relations inspired phrase such as maximizing shareholder wealth, this season's favorite, the market correctly discounts assets lodged with him. His heart is not listening to his mouth, and after a while, neither will the market. A number of shareholders have suggested to us that Berkshire repurchase its shares. Usually, the requests were rationally based, but a few leaned on spurious logic. There is only one combination of facts that make it advisable for a company to repurchase its shares. First, the company has available funds, cash minus sensible borrowing capacity, beyond the near-term needs of the business. And second, find its stock selling in the market below its intrinsic value, conservatively calculated. To this, we add a caveat. Shareholders should have been supplied all the information they need for estimating that value. Otherwise, insiders could take advantage of their uninformed partners and buy out their interests at a fraction of true worth. We have, on rare occasions, seen that happen. Usually, of course, chicanery is employed to drive stock prices up, not down. The business needs that I speak of are of two kinds. First, expenditures that a company must make to maintain its competitive position. For example, the remodeling of stores at Hellsberg. And second, optional outlays aimed at business growth, that management expects will produce more than $1 of value for each dollar spent. R.C. Wiley's expansion into Idaho. When available funds exceed needs of those kinds, a company with a growth-oriented shareholder population can buy new businesses or repurchase shares. If a company's stock is selling well below intrinsic value, repurchases usually make the most sense. In the mid-1970s, the wisdom of making these was virtually screaming at managements, but few responded. In most cases, those that did made their owners much wealthier than if alternative courses of action had been pursued. Indeed, during the 1970s, and spasmodically for some years thereafter, we searched for companies that were large repurchasers of their shares. This often was a tip-off that the company was both undervalued and run by a shareholder-oriented management. That day is past. Now, repurchases are all the rage, but are all too often made for an unstated and, in our view, ignoble reason, to pump or support the stock price. The shareholder who chooses to sell today, of course, is benefited by any buyer, whatever his origin or motives, but the continuing shareholder is penalized by repurchases above intrinsic value. Buying dollar bills for $1.10 is not good business for those who stick around. Charlie and I admit that we feel confident in estimating intrinsic value for only a portion of traded equities, and then only when we employ a range of values rather than some pseudo-precise figure. Nevertheless, it appears to us that many companies now making repurchases are overpaying departing shareholders at the expense of those who stay. In defense of those companies, I would say that it is natural for CEOs to be optimistic about their own businesses. They also know a whole lot more about them than I do. However, I can't help but feel that too often today's repurchases are dictated by management's desire to show confidence or be in fashion, rather than by a desire to enhance per-share value. Sometimes, too, companies say they are repurchasing shares to offset the shares issued when stock options granted at much lower prices are exercised. This buy high, sell low strategy is one many unfortunate investors have employed, but never intentionally. Management, however, seem to follow this perverse activity very cheerfully. Of course, both option grants and repurchases may make sense, but if that's the case, it's not because the two activities are logically related. Rationally, a company's decision to repurchase shares or to issue them should stand on its own feet. Just because stock has been issued to satisfy options or for any other reason does not mean that stock should be repurchased at a price above intrinsic value. Correspondingly, a stock that sells well below intrinsic value should be repurchased whether or not stock has previously been issued, or may be because of outstanding options. You should be aware that, at certain times in the past, I have erred in not making repurchases. My appraisal of Berkshire's value was then too conservative, or I was too enthused about some alternative use of funds. We have therefore missed some opportunities. Though Berkshire's trading volume at these points was too light for us to have done much buying, which means that the gain in our per-share value would have been minimal. A repurchase of, say, 2% of a company's shares at a 25% discount from per-share intrinsic value produces only a 0.5% gain in that value at most, and even less if the funds could alternatively have been deployed in value-building moves. Some of the letters we've received clearly imply that the writer is unconcerned about intrinsic value considerations, but instead want us to trumpet an intention to repurchase, so that the stock will rise or quit going down. If the writer wants to sell tomorrow, his thinking makes sense, for him. But if he intends to hold, he should instead hope the stock falls and trades in enough volume for us to buy a lot of it. That's the only way a repurchase program can have any real benefit for a continuing shareholder. We will not repurchase shares unless we believe Berkshire stock is selling well below intrinsic value, conservatively calculated. Nor will we attempt to talk the stock up or down. Neither publicly or privately have I ever told anyone to buy or sell Berkshire shares. Instead, we will give all shareholders and potential shareholders the same valuation-related information we would wish to have if our positions were reversed. Recently, The A shares fell below $45,000. We considered making repurchases. We decided, however, to delay buying, if indeed we elect to do any, until shareholders have had the chance to review this report. If we do find that repurchases make sense, we will only rarely place bids on the New York Stock Exchange. Instead, we will respond to offers made directly to us at or below the New York Stock Exchange bid. If you wish to offer stock, have your broker call Mark Millard at 402-346-1400. When a trade occurs, the broker can either record it in the third market or on the New York Stock Exchange. We will favor a purchase of the B shares if they are selling at more than a 2% discount to the A. We will not engage in transactions involving fewer than 10 shares of A or 50 shares of B. Please be clear about one point. We will never make purchases with the intention of stemming a decline in Berkshire's price. Rather, we will make them if and when we believe that they represent an attractive use of the company's money. At best, repurchases are likely to have only a very minor effect on the future rate of gain in our stock's intrinsic value. Charlie and I favor repurchases when two conditions are met. First, a company has ample funds to take care of the operational and liquidity needs of its business. Second, its stock is selling at a material discount to the company's intrinsic business value, conservatively calculated. We have witnessed many bouts of repurchasing that failed our second test. Sometimes, of course, infractions, even serious ones, are innocent. Many CEOs never stop believing their stock is cheap. In other instances, a less benign conclusion seems warranted. It doesn't suffice to say that repurchases are being made to offset the dilution from stock issuances or simply because a company has excess cash. Continuing shareholders are hurt unless shares are purchased below intrinsic value. The first law of capital allocation, whether the money is slated for acquisitions or share repurchases, is that what is smart at one price is dumb at another. One CEO who always stresses the price-value factor in repurchase decisions is Jamie Dimon at JP Morgan. I recommend that you read his annual letter. Charlie and I have mixed emotions when Berkshire shares sell well below intrinsic value. We like making money for continuing shareholders, and there is no surer way to do that than by buying an asset, our own stock, that we know to be worth at least X for less than that, for 0.9x, 0.8x, or even lower. As one of our directors says, it's like shooting fish in a barrel after the barrel has been drained and the fish have quit flopping. Nevertheless, we don't enjoy cashing out partners at a discount, even though our doing so may give the selling shareholders a slightly higher price than they would receive if our bid was absent. When we are buying, therefore, we want those exiting partners to be fully informed about the value of the assets they are selling. This discussion of repurchases offers me the chance to address the irrational reaction of many investors to changes in stock prices. When Berkshire buys stock in a company that is repurchasing shares, we hope for two events. First, we have the normal hope that earnings of the business will increase at a good clip for a long time to come. And second, we also hope that the stock underperforms in the market for a long time as well. A corollary to this second point, talking our book about a stock we own, were that to be effective, would actually be harmful to Berkshire, not helpful, as commentators customarily assume. Let's use IBM as an example. As all business observers know, CEOs Lou Gerstner and Sam Palmisano did a superb job in moving IBM from near bankruptcy 20 years ago to its prominence today. Their operational accomplishments were truly extraordinary, but their financial management was equally brilliant, particularly in recent years as the company's financial flexibility improved. Indeed, I can think of no major company that has had better financial management, a skill that has materially increased the gains enjoyed by IBM shareholders. The company has used debt wisely, made value-adding acquisitions almost exclusively for cash, and aggressively repurchased its own stock. Today, IBM has 1.16 billion shares outstanding, of which we own about 63.9 million, or 5.5%. Naturally, What happens to the company's earnings over the next 5 years is of enormous importance to us. Beyond that, the company will likely spend $50 billion or so in those years to repurchase shares. Our quiz for the day: what should a long-term shareholder such as Berkshire cheer for during that period? I won't keep you in suspense. We should wish for IBM's stock price to languish throughout the 5 years. Let's do the math. If IBM's stock price averages, say, $200 during the period, the company will acquire 250 million shares for its $50 billion. There would consequently be 910 million shares outstanding, and we would own about 7% of the company. If the stock conversely sells for an average of $300 during the 5-year period, IBM will acquire only 167 million shares. That would leave about 990 million shares outstanding after 5 years, of which we would own 6.5%. If IBM were to earn, say, $20 billion in the 5th year, our share of those earnings would be a full $100 million greater under the disappointing scenario of a lower stock price than they would have been at the higher price. At some later point, our shares would be worth perhaps $1.5 billion more than if the high price repurchase scenario had taken place. The logic is simple. If you are going to be a net buyer of stocks in the future, either directly with your own money or indirectly through your ownership of a company that is repurchasing shares, you are hurt when stocks rise. You benefit when stocks swoon. Emotions, however, too often complicate the matter. Most people, including those who will be net buyers in the future, take comfort in seeing stock prices advance. These shareholders resemble a commuter who rejoices after the price of gas increases, simply because his tank contains a day's supply. Charlie and I don't expect to win many of you over to our way of thinking. We've observed enough human behavior to know the futility of that, but we do want you to be aware of our personal calculus. And here, a confession is in order. In my earlier days, I too rejoiced when the market rose. Then I read Chapter 8 of Ben Graham's The Intelligent Investor, the chapter dealing with how investors should view fluctuations in stock prices. Immediately, the scales fell from my eyes and low prices became my friend. Picking up that book was one of the luckiest moments in my life. In the end, the success of our IBM investment will be determined primarily by its future earnings, but an important secondary factor will be how many shares the company purchases with the substantial sums it is likely to devote to this activity. And if the repurchases ever reduce the IBM shares outstanding to 63.9 million, I will abandon my famed frugality and give Berkshire employees a paid holiday.